Welcome back. This will be the shortest of the 8 units. We will review some terms that I want to make sure we have a common understanding of. The terms that we're going to be going over may have different meanings in different contexts, so let's make sure we start on the same page, understanding the terms for the purposes of this course. Those terms are risk, insurance, property and casualty insurance, personal lines insurance, business insurance, first party versus third party insurance, workers' compensation, liability insurance, property insurance, risk management, insurance agents and brokers, insurance company, and different structures such as stock, mutual, reciprocal, and finally underwriting. Speculative risk has two sides of the tail, loss and win. The stock market is the classic example of the same idea of variation in outcomes, but with profit as well as loss being potential outcomes. We will focus most of our attention on the downside of risk in this class, which is the chance of loss or pure risk. The actuaries and financial analysts define risk as the variation of loss about an expected mean. As with other forms of insurance, individuals and organizations can and will do things that reduce or increase their chance of loss, but that chance of loss still follows a random pattern. Let's look at driving a car, for example. Most of us wake up expecting to drive to work without having an accident each day, but you may have a fender bender while waiting in line to merge onto a street, or you may be struck by a truck that has just run a red light. When an auto insurance company looks at a pool of 100,000 insureds, they can start to get some predictability in how many of us will have that auto accident this year. And through that statistical analysis, they're able to reduce the risk to their company from its impact and price your auto policy to reflect the chance that you will be in that accident. For you as an individual, that risk and the personal and financial impact of that accident is very large if it does happen. But the same risk looks much different depending on your viewpoint, and that is the magic of insurance. What is a catastrophic risk for an individual becomes a very manageable event for an insurance company. And through that magic of insurance, you can transfer some or most of that risk to the insurance company. Let's say that risk at its simplest form is the chance of an event that causes personal and financial loss. Insurance cannot undo the personal loss, but it can and does provide funds for the financial loss. The classic definition of insurance is the pooling of fortuitous losses by transfer of risk to insurers who agree to indemnify insureds for such losses. The pooling of losses means that the insurance company insures a lot of people, most of whom do not have losses. Everyone pays for the losses of the few. The law of large numbers means that the more people that are insured, the more predictable their losses become. And this impacts the price of insurance, usually lowering it because it lowers the variation in loss or risk to the insurance company. Fortuitous losses means that the losses are unplanned by the person who is insured. They are a matter of luck, bad luck. The risk transfer means that the insured contractually transfers the financial impact of the event to an insurance company. The insurance company agrees to make the insured whole after their event, thereby indemnifying her for the financial consequences of the loss. The principle of indemnity means that if I cause a car accident and do $10,000 worth of damage to my car and $20,000 worth of damage to the car that I hit, resulting in a total loss of $30,000, the insurance company does not pay me $50,000. I do not get to profit from the event. They will only pay me $10,000 and likely pay $20,000 to the person whom I hit to put both of us back in the financial position we were before the accident. Property and casualty insurance is generally defined to be those lines of insurance that protect individuals, businesses, and organizations against losses to their property and for their legal liability for damage to other people and other people's property. Property and casualty insurance is distinct from life and health insurance which protects individuals from the financial consequences of illness, accidents, and death. Personal lines insurance is typically thought of as property and casualty insurance for individuals and families. This would be your homeowners or renters insurance that protects your home and personal property and also provides protection against your legal liability to third parties. Auto insurance that most of us purchase would be included here, as would a personal umbrella and watercraft insurance. By contrast, business insurance protects businesses and other organizations, such as governments and nonprofit organizations, against loss to their property and liability to third parties. Businesses often have very large investments in buildings, equipment, and inventory, and without insurance, most would not be able to get the bank loans that they rely upon to fund such investments. Some organizations have an even larger financial exposure based upon their legal liability to third parties, both based on common law, such as negligence, and statutes. Some examples of this exposure would be auto accidents, construction accidents, and products liability. Now, I've started to make some reference to this distinction between first-party and third-party insurance. First-party insurance is typically loss to property that you own, whether it's your home, a factory, or the office contents of a nonprofit organization. Third-party insurance, by contrast, would cover your legal liability for injuries to other people or damages to their property that you caused. Workers' compensation insurance is insurance that provides for the medical bills, lost wages, and other benefits for workers who are injured on the job while in the course and scope of their employment. It is considered a form of no-fault insurance, as the employee does not need to prove that the employer was negligent or at fault in the accident or injury. At the same time, the employer cannot try to allege that the employee was completely or partially at fault in causing her own injury and trying to avoid liability for the accident. Workers' compensation is often, though not always, the most expensive insurance line for businesses. Liability insurance, in contrast, insures against an individual's or organization's legal liability to a third party. Liability insurance typically covers tort liabilities, strict liability, and some forms of contractual liability. We'll discuss this form of insurance as well as the legal theories behind them in future units, but the basic idea is that you owe a duty of care to another person or organization. You violated that duty of care, and your actions caused injury or property damage as a result. The insurance will defend you against claims from third parties making these kind of allegations, and will pay for damages that you owe, subject to policy provisions, of course. Property insurance is first-party insurance, as we discussed earlier. For individuals, examples of first-party insurance would be the home, if you own one, your personal property, such as furniture, clothes, TVs, computers. For businesses, the same ideas apply in that property insurance covers their buildings, machinery, office furniture, and other items that can be damaged, destroyed, or lose value. Property insurance covers what is often thought of as direct damage to your property. Moving to risk management. It's many things, including a department in some organizations, but for this course, we will think of risk management as a process whereby individuals and organizations manage the risks that they face. Some companies take a very narrow view of risk management as it pertains to traditional insurance risks, while others take a very wide view of risk. In either case, the process is often the same and includes identifying the risks, measuring and quantifying them, coming up with alternatives for managing the risks, and then implementing the chosen risk management techniques, and finally, monitoring the effectiveness of these techniques with a feedback loop that periodically starts the whole process over again. Insurance agents and insurance brokers both appear to be salespeople who are trying to sell you insurance. There is a fine but at times very important distinction between the two, and that insurance agents are agents of the insurance company and are working for the insurance company and not you, the consumer, in theory. Insurance brokers, by contrast, work just for their clients you the consumer, and only have the incentive to negotiate the best deal for you. Again, in theory. Brokers are also often paid differently, directly by their client in the form of a fee rather than a commission from the insurance company. Now, in practice, there are many very good insurance agents who truly put their clients' needs first and always provide appropriate advice, and there are some brokers who don't do a good job serving their clients' needs. You should keep in mind, however, that the insurance agent is being paid by the insurance company and may at times be conflicted between the company's interest and yours. Let's turn to insurance companies now. They're very different animals than most companies. Like other financial service companies, their financial statements have unique characteristics, and they are heavily regulated at the state level by departments of insurance. Here in Wisconsin, the Department of Insurance is called the Office of the Commissioner of Insurance, or the OCI. Almost sounds like a TV show, but trust me, it's not an exciting place. Insurance companies, similar to banks, can be stock companies or mutual companies. Stock companies have owners, the stockholders, who elect the board of directors. Stock companies are going to be focused on being profitable with dividends paid to the stockholders. Mutual companies, by contrast, are owned in theory by their policyholders, who in turn elect the board of directors. In practice, very few policyholders vote, so the board and management really run the company. Dividends can be paid to policyholders either directly as dividends or through reduced premiums. In practice, policyholders are not demanding dividends. They are used to keeping the premiums competitive with other insurance companies. Due to their structure, most mutual insurance companies do not have to be as focused on quarterly earnings, and often mutuals will tout this as their ability to do what is best for the long run rather than what is best for this quarter. At the same time, mutual insurance companies may have a perceived lower cost of capital due to their structure, which could result in lower premiums. Reciprocal insurance companies are similar to mutuals, but are managed by an attorney-in-fact and may be assessable. That means that if there are more losses than they planned on, they can come back to their policyholders and ask for more money. No matter what line of insurance we are talking about, underwriters often get a bad name. When you seek to buy insurance from an insurance company, the underwriter process is, and in some cases, an actual underwriter decides whether or not to accept your application and issue a quote, and if so, they set the price as well. The underwriter practices discrimination, and the state allows it as long as it is not unfairly discriminatory. Unfair discrimination would be based on race or nationality, for example, and fair versus unfair discrimination is at times defined in statute, but generally is meant to mean that underwriters can only discriminate in areas that are valid predictors of increased hazard. A person with a bad driving history, for example, has an increased hazard of future accidents, and in most cases this is seen as a valid point of discrimination in charging a higher rate. The quality and ability of the fire department to respond quickly to a house fire in your town is also an example of a risk factor that can impact the insurability and price of insurance for your home or apartment. Thank you, and that is it for this first unit.